Hi, Clay. This is a quick walkthrough of the Peak Performance Inc. Combo Retirement Plan proposal, a cash balance plan paired with a 401k. The goal of this presentation is to make the plan easy to understand, show the estimated contribution and tax impact, and explain what the ongoing requirements and fees look like. Here's what we'll cover, Clay. First, what the combo plan is and why it exists. Then we'll look at the plan snapshot, the key settings, and how many people are included. After that, we'll review the illustrated contributions and tax impact for 2025 and the funding rules and deadlines. We'll also cover the 401k safe harbor match and Secure 2.0 auto enrollment defaults, then wrap up with fees and next steps. This combo plan has two parts. The first is the cash balance plan, which is a pension style plan that lets the company contribute much more than a standalone 401k would allow, especially for owners and key people. The second is the 401k plan with a safe harbor match. The 401k helps employees save, and it also helps the overall plan pass compliance testing, which is important when you're doing higher contributions through the cash balance plan. Here's the easiest way to understand a cash balance plan, Clay. Each participant gets a hypothetical account. Every year, the employer puts in a pay credit, usually set as a fixed dollar amount or formula, and the balance also receives an interest credit, shown here as an illustration at 3%. Even though it looks like an account, it's still a defined benefit plan, meaning the employer must fund it appropriately each year so it stays on track. Now, Clay, here are the key settings for the 2025 plan year. The business is an S corporation. The plan effective date is January 1st, 2025, and the year-end valuation date is December 31st, 2025. There are 17 participants in the 401k and 13 participants in the cash balance plan. Eligibility is age 21, 12 months of service, and 1,000 hours. Investing is shown here. The cash balance is fully vested after 3 years, and the 401k employer contributions vest over time based on the schedule listed. This slide is the big picture economics for 2025 based on the illustration. The total tax deductible contribution shown is $764,713. The owner's share of the total is illustrated at 86%. And the estimated tax benefit is about $305,885, assuming a 40% marginal rate. The key takeaway, Clay, is the plan is designed to allow a large deductible contribution, and a large portion of that is directed toward owners in the illustration. Here's what the allocation means in plain terms, Clay. In the illustration, owners receive roughly $654,000 of the total, and employees receive about $110,000, mainly through required contributions and the 401k safe harbor structure. This is how combo plans are usually designed. Owners get the bulk of the benefit, while the plan still provides appropriate contributions to employees to stay compliant. Final amounts always depend on year-end payroll, census data, participation, and testing. This slide is critical, Clay, because it explains the required funding rules for the cash balance plan. Based on the valuation at December 31st, 2025, the minimum required contribution shown is $543,611, and the maximum contribution shown is $504. The amounts listed below show how the required payment grows slightly over time due to interest adjustments, meaning the longer you wait to fund it, the more you may need to contribute. And importantly, contributions are generally due by the business tax filing deadline, including extensions, and the internal target shown here is to fund no later than mid-August of 2026. This is the annual checklist that keeps the plan running smoothly. In January, you submit your year-end census and asset details so the valuation and compliance testing can be completed. Then funding is made by the earlier the tax return due date or September 15th for calendar year plans. After funding, you confirm the amounts and funding dates, and then the Form 5500 is prepared and filed, typically due by October 15th. The main point here is that this is an annual process, and contributions are not optional. They need to be planned for. Now, Clay, let's talk about the 401k side. New 401k plans commonly include automatic enrollment defaults. The default deferral rate is shown here as 10%, but employees can opt out or change it. Secure 2.0 also requires auto escalation, increasing by 1% per year until it reaches 10%. There are exceptions to the auto enrollment rules listed here, like certain small businesses and companies under 3 years. Finally, the safe harbor match formula, shown as 100% match on the first 3% deferred and 50% match from 3 to 5%. This match structure helps satisfy compliance requirements. This slide explains common ways plan assets may be funded. Some designs use whole life insurance for stability and death benefit features, or annuities for guaranteed returns. Others use traditional investments, like a diversified portfolio for long term growth. If life insurance is used, there are guardrails. One of the big ones is the incidental benefit rule, typically meaning no more than about half of employer contributions can go toward life insurance premiums in a defined benefit plan. The goal is to keep the plan primarily retirement focused and compliant. This is the setup process at a high level. The goal, Clay, is to go from proposal to signed documents, establish the trust and custody accounts, implement the 401k and cash balance structure, and then fund the plan properly. Once it's installed, the plan runs on an annual cadence, census, valuation, compliance testing, funding, and annual filings. Here are the quoted fees from the proposal. The one-time installation total is $2,750. The annual administration total is $5,500, payable annually, including the first year. There are also per participant estimate ranges shown for the DC and DB portions. The exact total can vary depending on the final year-end participant count. The main takeaway, Clay, is there's a one-time setup cost and then an annual administration cost to keep the plan compliant. To move forward, Clay, the key decisions are: confirm the plan design inputs, meaning pay credits, classes, and the interest crediting approach, and decide how you want the plan funded, whether through insurance, annuities, investments, or a blend. You'll also want to finalize the 401k record keeping approach in your employee communications for safe harbor and auto enrollment notices. Then you complete the installation packet, execute plan documents, establish the trust, and set an internal calendar so the plan is funded and administered correctly every year.